Good morning, everybody, and welcome to the first in this series of webinars on the use of alternatives in managed account programs. It's a pleasure for us today to be joined by Andrew Lockhart, Chad Hitzeman, and Claire Smith in a series that's going to be moderated by Daniel Stojanovski. Let me just say a little about Daniel, our moderator for our series. Daniel is the head of research for Centrepoint Alliance and has been there for about a year now. Prior to that, he was fulfilling a role of portfolio manager at IOOF, where he was for 5 years. And in prior roles, had worked with Challenger and Morgan Stanley, within their investment management division. Before I hand over to Daniel to say a little about to introduce today's presenters and say a little about today's topic, let me just tell you a little about the other two sessions that we have in this series on Wednesday at lunchtime and Friday. So we'll be looking at growth assets today, defensive assets on Wednesday, and then on Friday we'll look to get the researcher's view on alternatives. Look, it's a troubling time for all of us. 16 million of us locked down, and I hope for you it's something that you're able to cope with. For us, it's meant the cancellation of a number of live events, but we do have quite a program coming up through the rest of the year, and I've chosen a number of events to highlight. Later this month, on the 25th of August, we'll be announcing the winners of the IMAP Managed Account Awards, 5 asset classes, innovation, and the licensee awards. So I'd encourage you to join into that. On the 13th of September, we'll be running a webinar on the state of managed accounts. I'll be joined by Millermans and Premium, and we'll announce on the 13th the total fund size for June 2021. And we'll be talking a little about the shape of managed accounts at a time of significant change for advice. In November, a new thing for us in independent thought. And Daniel's role as portfolio manager in a licensee organisation is absolutely representative of our goal with independent thought, to showcase the thinking, the approach, the constraints and opportunities which managing portfolios from the basis of an advice business gives rise to. So this is an opportunity for us to showcase just the excellent work which is being done in managed accounts based at a licensee level. And then here's hoping we can get together in later November as well at the FPA Congress, when again IMAP will be running Managed Account Central, a showcase for 8 managed account providers. So it's now my pleasure to hand over to Daniel Stojanovski, the moderator for today, Wednesday and Friday, to talk about the series and to introduce our guests. Daniel, over to you. Thanks very much.
Thank you, Toby, and thank you for having me. I just think I might first start with some of the housekeeping sort of rules. So in terms of question and answers and how to ask a question, at the bottom of the screen or the window, you'll notice a Q&A sort of icon there as marked by the red arrow. Just click that and type away, and we'll be able to get some of those questions in, so we can hopefully get to that towards the end for the different speakers. Awesome. So as Toby mentioned, we'll be running 3 unique sessions over the course of this week, focusing on those growth alternatives, defensive alternatives or income, and lastly, bringing it all home with a discussion with some of the large research houses, Morningstar, Lonsec, and Zenith. In today's session, session 1, we'll be focusing on growth-like alternatives. The purpose of growth alternatives is to provide a substitute to listed equity markets within the growth component of a diversified portfolio. At Centrepoint, we really look at alternatives, or the alternatives asset class, in two main ways. The first is, I guess, approaching it from a view that alternatives is there to really generate return when equities and bonds are finding a little bit challenging. And the second reason is to broadly diversify the portfolio in order to harvest returns to better help on a risk-adjusted perspective in comparison to those equities and bonds, whilst doing so in a very low correlated fashion. So helping us better understand these specific options and strategies in this space, we have the following speakers, which I'd like to introduce. So the first is Andrew Lockhart from Metrics Credit Partners. Andrew is a managing partner and member of the investment committee at Metrics Credit Partners. His background prior to establishing Metrics was in banking and finance, where he was responsible for the origination and portfolio risk management of large, diversified and complex loans transactions. Andrew has a substantial direct lending skills, including corporate restructuring. Thank you, Andrew, for being here. Second, we have Chad Hitzeman from ETF Securities. Chad is responsible for servicing private banks, asset consultants, and financial advisors across New South Wales, Victoria, and Queensland. He joined ETF Securities in 2017. Thank you, Chad, for coming today. And last but not least, we have Claire Smith from Schroders. Claire is an alternatives director at Schroders based in Sydney. Claire is responsible for working with clients to determine how private assets may help them meet their investment goals. With over 17 years of experience, Claire has been involved in development and implementation of structured finance initiatives, managed funds, and structured investment solutions for both institutional and wholesale clients, covering a wide array of asset classes, including infrastructure, equities, commodities, mortgages, and private debt. Thank you, Claire. How we might start this session is to really hand over to the presenters specifically to sort of go over what they're trying to achieve in their strategies, the influences and the alpha they're trying to capture. And then we'll go into a discussion thereafter. So what I might do first is hand it over to Andrew to start us off.
Thanks, Daniel. So Andrew Lockhart's my name. I'm from Metrics Credit Partners. Metrics Credit Partners is a business that was established in June of 2013 when we launched our first fund. We currently manage close on $9 billion Australian across a number of strategies. Our core skill set is directly lending to Australian and New Zealand-based companies, where we seek to originate lending opportunities directly with those companies, where we negotiate the terms, conditions, set the covenants, take security, and provide the financing to these groups. And we really compete with and we work alongside banks in providing financing to a range of companies. Across our funds for investors, we have 13 different vehicles, which really reflects the fact that the Australian and New Zealand lending market is not a homogenous market. Credit is not an homogenous asset class. And what I mean by that is in each of the vehicles have been structured to cater for individual investors' requirements around what is their return objective, what is the risk that they're prepared to take to generate that return, and then what are the liquidity features available with the investment product that allows the investor to manage their own investment liquidity. And so across the spectrum, from very high investment grade borrowers through to sub-investment grade borrowers, our funds cater to that broad range of lending opportunities. And equally, we participate through the capital structure. So importantly, from our activities, what we're seeking to do is to bring our investors closer to the point of origination, where you capture the lion's share of the economics through fees that are charged to borrowers, but you also have direct influence over the terms and the conditions, and you negotiate the pricing that reflects the risk. And so obviously as a lender, what we're seeking to do is to ensure that equity wears the lion's share of the risk associated with providing financing. So if you think about the capital structure, investors will invest in equity predominantly to generate growth in capital, and they will invest in the debt part of the capital structure to preserve and protect their capital and generate an acceptable income. But equally, as a skilled private markets lender, we often see opportunities where the provision of capital to the company is really what drives the earnings growth and the opportunity for shareholders. And so as a lender, what we also seek to do is where those opportunities present, give our investors the ability to participate in upside capital gains. So from a portfolio construction perspective, we have a range of funds that we believe cater to alternatives to traditional fixed income. And then we also have a range of funds that are higher income generating, higher growth generating investment opportunities that really cater to an alternative to equities. And so across our spectrum, we seek to provide investors with a range of choices in those areas. And each of the funds represent the risk and return that is available through properly structured loans and negotiation of those instruments directly with companies. And to give an example, investment grade borrowers, you might be in the low 100 basis point type return, whereas in the high yielding funds, you're going to be looking for 15 to 20% plus in terms of total returns. So it is a spectrum of returns and risk that we seek to provide our investors exposure to. But importantly, what we also try to do is diversify that exposure by ensuring that our investors' capital is not exposed to any one individual counterparty that might impact the ability of maintaining capital preservation as a key. So I might pause there and back to you, Daniel.
Thank you so much, Andrew. That was great. I might get Claire next to just go over the introduction.
Sure. Thanks, Daniel. And Toby, I think I've got a couple of slides. I'm not as good at ad-libbing as Andrew is apparently. So yeah, thanks for having me today. The fund I'll be discussing, or the strategy I'll be discussing, is what we call semi-liquid private equity strategy. So private equity is an asset class that we've been investing in for over 20 years now. We have a global platform with 46 investment professionals dedicated to private equity across 5 offices. Our strategy focuses on 3 main pillars. So we focus on small to mid-sized buyouts in Europe and the US, and I'll take you through some statistics in a minute on why we think that's a good part of the market to be in. We also follow the growth story in Asia, so the increasing wealth in the middle class, the changing in consumption patterns, and really trying to generate returns from harnessing that. And lastly, we have a small allocation to venture capital within this fund. It does comprise less than 10%, so it's the risk of the venture capital is balanced nicely with the returns from the other asset classes. But venture capital is actually the team's foundation. It's the longest running strategy they have, and obviously venture capital can provide some really interesting return drivers. So the fund itself is, semi-liquid, and I'm sure we'll explore this more throughout the session. What that means for us is you can invest on a monthly basis and then redeem on a quarterly basis. We do require a 1-quarter notice period. So, hence this is sort of I guess you'd call it a risk of the fund, in that it does take realistically between 4 to 6 months to access your capital, which is something we do try to be very upfront about. And the reason we sort of recommend the fund for sophisticated investors. It is a retail fund, so it is accessible by all investors and self-managed super funds regardless of their investment status, but nonetheless, obviously just a feature to be aware of. It's an Australian domiciled fund, Australian dollar NAV, available on all the major wrap platforms. And one other thing we did try to do with this fund to keep it as cost efficient as possible is we decided to waive all the performance fees within the structure. Being a semi-liquid and an evergreen structure, it can be quite complicated to calculate performance fees if you choose to charge them. So to really keep it as clean and simple and transparent as possible, we did decide to waive all those performance fees. Just on the next slide, we've got a couple of, I think, interesting statistics around multiples in private equity, because obviously with, listed equity markets trading at all-time highs, I think people are asking the question, is there still value to be captured in either listed or private equity markets? And what this data here shows is we classify a small buyout company as having less than $100 million or euros of enterprise value, and a large company as having greater than $500 million or euros of value. And what you can see is, over the past sort of 15 years, there has been about a 3 times structural discount in the small to mid-size, in the small sized part of the market across both Europe and the US. And this is a phenomenon that we think will continue because of simply return on effort. So it takes the same amount of effort to source, underwrite, structure, analyze a small company as it does to analyze a large. And when you've got, big superannuation funds, big Canadian pension plans, big UK pension schemes, all sort of chasing that large end of the market, along with all the jumbo funds, there's a lot more competition and price tension. We think in the smaller end of the market is more fragmented. There's more opportunities to pick up really interesting companies at lower multiples, which obviously allows you to grow them and then exit them at a greater profit. And then on the final slide, I thought I would just quickly talk through, what can you expect from a strategy like this? So what are we trying to deliver? So we calculate the team's 10-year rolling return and compare ourselves to MSCI World, because obviously private equity is just another form of equity exposure. You are investing in companies, it's just the difference is obviously they're privately owned rather than listed. So when we look at these statistics, you can see we've managed to outperform listed markets by sort of 3 to 4% per annum on average. And importantly, we've also delivered that at around half the volatility. And it's important to note this is a like-for-like volatility comparison. So we've taken the quarterly MSCI World valuation points alongside the quarterly valuation points of our strategy, and you'll see that we have delivered that outsized return at a much lower volatility. And so that's what we hope to continue to do with the semi-liquid fund we've structured. That was all for me. Thanks, Daniel.
Thank you so much, Claire. And lastly, I might just pass it on to Chad with ETF Securities.
Perfect. Well, thank you, Daniel. Thank you for having us. I'm going to run through GOLD. So I'm from ETF Securities. We run a physical low-cost liquid alternative in the form of gold. We've been running GOLD for 18 years now, and hopefully that in itself testifies, so to speak, to the durability of gold as an alternative asset, given that we've been able to build a business on it for 18 years. It's not the only asset we have, of course. We also cover a variety of thematic areas with our equity ETFs. Now, it usually takes me 7 minutes or so just to warm up. But given the time limitations today, I'll keep the commentary swift and high level. Beginning from the beginning, our standpoint on gold is that it's portfolio insurance. It's trite, but it's true. The goal, however, for investors who attach a premium to weatherproofing portfolios by using gold is to keep front of mind its strategic long-term value add, which is controlling portfolio risk. Gold tends to pay when core components of a portfolio like equity suffer. It's not necessarily a get-rich strategic asset, but something of a stay wealthy asset insofar as it minimizes capital drawdown. So gold enables allocators to take risk on positions in equities, knowing there is a ballast behind these in the background that can perform well if equities reverse course. All of this is simply to say that gold allows investors to have a pre-position, so to speak, in a fairly non-complex asset, which tends to shine in risk-off scenarios without having to worry about timing the fact of a fire in entry into risk-off positioning. Note that since the inception of GOLD in 2003, its annualized returns for those 18 years has been 8% until the end of July last month. Now, gold's diversifying effect comes from the fact that its correlation, its co-movement with other assets like equities has been durably low to negative. Over the past 30 years, for example, Australian dollar gold's correlation to the Australian equity market in the form of the all ords has been negative 0.24. And in terms of the international equity space, taking the S&P 500 as an example, it's been negative 0.36. So gold is a diversifier in the context of asset allocation. It means gold can improve measures of risk-adjusted returns like the Sharpe ratio, things like the Sortino ratio in balanced portfolios. It tends also to lower the beta of portfolios, the market sensitivity. And given it's a safety asset, it can also lessen max drawdowns and smooth investors' return experience throughout the course of the life of a portfolio. That's the value of having gold nestled in portfolios as something of an anti-fragile stabilizer. In some, then the role of gold is a modest one, but fundamental one from our standpoint. It's certainly not cash giving as an asset, but precisely because it doesn't have things like sales, revenues, earnings, etc., it's distinct from equities, and hence gold's diversifying effect. The other thing to keep in mind is that gold is a liquid alternative asset, which is, from our viewpoint, it's particularly important given gold is used for its defensive qualities. So this means investors don't have to worry about redemptions and issues around that, and so can use a good asset like gold to raise cash if needed when markets fall. Now, just briefly, because this is an item of discussion touched on when it comes to gold, is for me to speak on the valuation of gold. As mentioned, gold doesn't have cash flow and therefore isn't something you can value by way of a discounted cash flow model. Gold at once is a tangible, real asset, but something of an abstract asset, in that its price tends to be driven by correlation to things like equities, as already mentioned, but also US real yields. That is after inflation risk-adjusted returns. Actually, incidentally, that's the pathway by which we think inflation affects gold's price, is by way of after inflation risk-adjusted returns, not just in inflation alone. So with real yields, these tend to move in opposite direction to gold's price. There's something of a logic for this, in that a cash-giving asset is judged relative to a non-cash giving asset. So to put this concretely into perspective, the degree to which real yields have explained gold's price movement, the model that we track shows 84% or so of gold's price change can be explained by changes in US real yields. So for every 25 basis point change in the US 10-year real yield, the treasury, there's often a corresponding opposite change in gold's price by $80 per ounce. And it makes sense that gold tracks real yields from the perspective that when these are low and negative, and keep in mind there's a substantial pool of global fixed income assets that are negative yielding, they kind of indicate a stressed macro environment. So to have a finger on valuation when it comes to gold, real yields can be used to judge whether gold is trading at a premium or discount to these risk-free after inflation rates. Now, the last thing I'll raise is the product structure of GOLD. It's often the case that those who use GOLD want to know how robust its product structure is. You know, whether there's gold in the vault, whether there's a one-to-one link between the number of ETF units on issue for GOLD and the gold within our custodial vault with JP Morgan in London. I realize that, you know, precisely because gold is viewed as something of an ultimate doomsday hedge, if you will, that product structure matters. And so with GOLD, the key thing for me to point out is that not only is it physically backed, so for every unit issued of the ETF, there's a corresponding influx of gold into JP Morgan's vault, but there's also an entitlement to metal that investors have, meaning that unit holders have immediate ownership over the underlying gold, which not all ETFs are structured that way. So GOLD has weathered all sorts of market dislocations over the course of its 18 years, from the GFC to the pandemic. So hopefully that highlights the strength of the fund structure. But thank you for having me, and I look forward to any questions you might have.
Awesome. Thank you so much, Chad. I think I might invite all the panelists now to really sort of have a little bit more of a discussion in terms of questions around alternatives and your strategies. And I think just to kick it off, and this is a question more from, I guess, advisors everywhere in terms of how they use alternatives, if they do or they don't, but why would they put your strategy in a portfolio? And specifically, how would you want to blend your strategy with other asset classes? I might get Claire to start that one.
Yeah, sure. So, you know, ours is simply an unlisted equity allocation, so it should sit firmly in the growth bucket. We don't pay any income out, so it is a pure accumulation, wealth creation tool. Most people, there's two sort of ways to think about it. We often get put in the alternatives because it's a semi-liquid asset class, but in terms of concept, it should really just sit in an international equities allocation because we're providing access to, international equity in companies. It just so happens that they're privately held rather than listed. So yeah, very much growth, international equities.
Andrew, your view on this one?
Oh, look, I think from our perspective, the rationale for putting corporate debt into the portfolios is really to drive predictable, stable capital, whilst also delivering an attractive income. And the asset class is truly not correlated with equities or public market securities. And so when I think about our asset class, there are a range of things that you can do as a private lender that give you control and protection that you wouldn't have necessarily in a public market bond. For instance, the ability to compel companies to not pay dividends or distributions, the ability to lock up asset sales or prevent companies from making future acquisitions, the ability to exercise that degree of control is a protective measure that you take. And so we would say that there are two areas where, from a portfolio allocation perspective, it makes sense to invest in private credit. One is the traditional alternative to traditional fixed income, and getting a source of return that is based on the skill set of the manager in terms of being able to generate fee income and originate opportunities. The other area of interest is really on the growth side, which is using our skill set to negotiate with companies where you can give investors access to upside capital gains. And that may be, if we're lending to the company, we may want to take options, or we might want to hold warrants over the equity, or we might take an outright equity interest in the company, or we might negotiate a profit share with the company in exchange for the provision of the loan. So in that case, I would say that kind of decision in terms of portfolio allocation would more skew towards an equities replacement.
Oh, great. And Chad?
So, at ETF Securities, I've been here for about 5 years now. And I think, from our research and the way that advisor clients are using gold and so forth, we usually see it as 5% within the alternatives bucket. It depends on how you want to classify it, as a growth alternative or a defensive alternative. I've seen both. But the core thing here is that, that's a strategic type of weighting, a buy and hold weighting. If you want to play it tactically, which if you want to incur kind of timing risks, I've seen clients attempt to achieve kind of alpha short term in the presence of price drivers like collapsing real yields. And keep in mind, real yields are no better this year than what they were last year in a pandemic-stricken economy. So in other words, they're still in a malaise. But so I think that from a tactical viewpoint, I've seen advisors go all the way up to 10%. But on a buy and hold basis, I think there's an argument to be made of 5%. After which, and I had a slide for this, which I did send through, so hopefully you can disseminate that to the audience. But just in terms of, as you allocate beyond 5%, there is something of a drag on portfolios, equivalent to a cash drag, if you will. I mean, it doesn't give income. It's suboptimal in that sense, but it really does have a place as a diversifier, buy and hold 5% in the background. So it's kind of a barbell strategy vis-a-vis your risk on equity assets. So that's more or less how we see it.
And I guess on that, Chad, is given that gold can go through prolonged bear markets at times historically, and we've seen that even in recent times, so being a little bit, in terms of how you explain that to clients, is I guess you want to be a little bit more tactical when using your type of strategy. Is that correct?
Yeah, it's a funny thing. Okay, so it's interesting. So straightforward. If you want to time the market, let me provide an example. We had the expectation, as I think a majority of market observers and fund managers thought that the 10-year US Treasury was going to go up on the back of this accelerated economic growth, but it really hadn't. I mean, Q1 it did, it accelerated, overshot, it collapsed in Q2, it's trading sideways basically, and in Q3 now it's kind of risen in response to the positive employment numbers. But the point is, you know, gold we thought might decelerate a bit, and it has come off a little bit, but not to the magnitude we were expecting. So it's just a case in point. If you want to try to be tactical, there's always risk that you're going to get it wrong. And as a matter of fact, you know, what's so challenging about doing that is gold's outsized returns are infrequent. So in other words, to get those outsized returns, if you're tactically timing it, you have to be very precise and very on point. Otherwise, you're going to miss it. You're going to have a distaste in your mouth in terms of, oh, gold, it doesn't really work well. That's why we think, you know, over the long term, and I mentioned, since we've been running the fund since 2003, over 18 years, the annualized returns have been around 8%. I'm sure those are going to moderate a little bit, but over the long term, since the 1970s, gold's price, you know, annualized returns has been around 7%. So it does have some positive impact long term, aside from tactical allocations.
And I guess in continuing on with that, I guess what scenarios would be supportive of your strategies in general? And I think that'll be probably another broader question that we might want to sort of go through. So Andrew, did you want to start with that one?
Oh, look, I think from our perspective, our strategies work through cycles. At the end of it, what we're about is, you know, if you actually think about the Australian market and New Zealand market, Australia does not have a deep, liquid, functioning corporate bond market where companies can access financing. They're heavily reliant on banks, and most companies don't have ratings. And so the simple fact is that the banks are being pushed into a regulatory position that sees their capacity to continue to provide the financing to companies that supports economic growth being impacted. And so there's effectively a need for people like ourselves to come together, raise capital, and be able to provide what we think is a very important alternative non-bank source of debt financing to companies. It supports the growth and economic activities of those companies. And so as a lender, what you're seeking to then do is to ensure that you've taken all necessary steps to protect and preserve your position, because you're providing financing. You're not an equity investor. You're not trying to back management to deliver outsized returns. So it's a core activity that's in the economy, providing financing to companies to support their growth and economic activity. So from our perspective, what we're trying to deliver for our investors is to ensure that our investors are being paid for the risk. And that means understanding capital structures, understanding what are the sources of cash flow that drive the earnings growth of companies, and to ensure that you've got an acceptable alignment of interest between a lender and a shareholder and equity provider. And so from that perspective, our strategies work regardless of economic circumstances. One thing that does impact it is the level of market liquidity that is available. And so if the banks are awash with capital and they're lending, or markets generally are chasing yield, then you'll see a downward decline in margins and fees. But generally, as a lender, what we're looking to say is, well, you know, there is a lot more opportunity for us than we have capital available to us. So therefore, we can pick and choose. And we do around about 20% of all of the deals that we see. And part of that is a process of negotiation on what are the appropriate terms and conditions and the way in which we'll manage risk. But equally, investors are expecting us to represent them when we negotiate with a company. We've got to be driving and ensuring we're getting a fair price for our investors' capital.
That's interesting. Now, Claire on that one.
Yeah, sure. I mean, the benefits of private equity are, I mean, it's you really have to take the liquidity into consideration, because when you look just on a return and a volatility basis, it has a higher return than listed equities and a lower volatility. So under any metric, you should hold private equity in your portfolio at all times. What we see usually is during times of market stress, you know, that distress selling comes into equity markets, and obviously you get a self-fulfilling prophecy of listed markets falling dramatically as, you know, sentiment and people are nervous and obviously sell at the wrong time. The good thing about private equity is, number one, it's hard to sell that quickly. So you remove some of that stress from your portfolio. And also because you are valuing your companies on usually fundamentals, particularly in the small end of the market where we're in, where we're not proxy valuing off listed markets. We're valuing the companies based on their fundamentals. So, for example, during COVID, our portfolio came down about 5% because on the 31st of March 2020, the outlook was pretty dire, and we downgraded a few revenue assumptions, to reflect the uncertainty in the market. Though traditionally private equity, when listed markets jump up, private equity will lag because it does take time again for that sort of improved economic outlook to be priced into the companies. But surprisingly, what we saw with the COVID rebound is our actual private equity portfolio rebounded even faster than the market, which is quite unusual. But I think it's, we focus a lot on healthcare and technology. They make up over 50% of our portfolio, and they've obviously been the real winners from COVID. So it's been, I think we were lucky that, well, not lucky, skillful, I would say that, I think like a lot of managers, we saw the economy was obviously due a downturn with COVID. We didn't know what it was going to be from, but we'd repositioned into, non-cyclical consumers, healthcare and technology, and obviously they've been the real winners. So, I would just say that, the kind of nice and difficult thing about private equity is it's difficult to invest tactically, but, if you hold a portion of it in your portfolio under all metrics over a long period, it should improve your outcomes.
Yeah, and Chad, just quickly, just on a scenario, just in regards to gold.
Now, the one thing to mention is because of that negative correlation, it does tend to be the case that gold, if equities are accelerating and there's a lot of momentum behind them, that gold tends to not perform in step with equities. But that's the purpose of gold. I suppose advisor clients who use it in portfolios have to, as I said, have to be very cognizant of its function. I mean, if you're composing asset allocated portfolios with your various buckets, and if you want a simple, non-complex, liquid, low-cost alternative over the long term, gold fits in that sleeve. I mean, if you're talking about scenario analysis, there's a variety of them, one of which is inflation overshoots versus kind of these so far for the past 2 quarters sticky nominal yields, and whether or not they're going to beat inflation, relatively speaking, so that real yields improve. If you want to try to play it that way, certainly I've seen investors do that. As a matter of fact, there's something of a, advisors that are doing precisely that, taking out that trade idea view. But if you want to get into the details, the devil in the details in terms of those scenario analysis, I can certainly do that as well.
No, thank you. Thanks everyone for your comments around this. And I think in regards to that first question, how we approach it in general is, I think they sit in alternative buckets due to their ability, I guess, managing the risks and our expectations of different strategies, but specifically around, what they're trying to achieve and controlling that equity beta risk that comes from other parts of the portfolio. And just on that, what risks are we really taking on with your strategies? I think that's probably something that advisors do really ask and clients really do, because the sophistication of some of the strategies, I think is one aspect in terms of people not really understanding, but really, around those risks. Claire, did you want to start with that one?
Yeah, sure. Happy to start. Yeah, so I mean, the risk of sort of our strategies, you have a an underperforming economy and companies not generating as much profit or producing enough profit. I mean, we do have the benefit of a globally and sectorially diversified portfolio with the the US, Europe. Sectors like venture capital aren't really correlated to the general economy because it's about finding the next unicorn, finding the next Uber Eats or whatever that's going to be profitable regardless of the state of the world or the economy. So you do get some benefit from that, but I think it's definitely equity risk, and you are at the companies we invest in are smaller than listed companies, so you do have to understand that there are some that might go insolvent, and then the second risk, as I've mentioned, is that liquidity piece, just thinking about managing clients' cash flows. And I did notice there was a question in the chat just about managing capital calls within a managed account structure, so I thought it was worth just flagging that for our private equity fund, all the capital is called on day one, so there's no ongoing capital calls to manage. It's when you make an investment, all the capital is called, and then when you redeem, all the capital is returned without income, so at least there's nothing to manage from that operational side.
Andrew, your view?
Yeah, the our asset class is not something that can be bought and sold over a screen. And so, you know, as a lender, what you're doing is undertaking detailed fundamental risk assessment of the company you're lending to, and then you structure terms and conditions and provide the funding to that company. You're not looking to be able to buy and sell and trade out of a position. And so the biggest risk that an investor would be exposed to investing in debt is obviously the risk of default and a loss given a default. And so, you know, obviously it's a materially lower risk than equity. Again, you think about where you sit in the capital structure. And obviously, you know, if you think about in the world of equity, say the company is trading on an EV to EBITDA multiple of say 10 times, you know, you may have only 4 times leverage against the earnings. And so you're effectively saying that more than 50% of the capital structure needs to be at risk to shareholders and equity. And so as a lender, what you can do is you can sustain material deterioration in terms of performance of the company, changes in valuation, because that risk of loss should be the buffer that is absorbed and worn by shareholders and equity. And so as a lender, one of the things that's really important is that you then don't get into a position where you become a forced seller. And so in most of investors have experience in bonds, and they say that it's an asymmetric risk in that you can only go down, and if you lose money, then you're going to lose money. But as a lender, that's particularly a lender that's not regulated by APRA, at the end of it, we don't have leverage. So to the extent that the company was to deteriorate in credit quality, then we should have and do have appropriate workout and corporate restructuring skills that allow us to then go through a restructure, wipe out shareholder equity, take control of the company and trade the business on, not only seeking to ensure you get your capital back, but potentially providing investors with capital gains over time from improved recovery. So the biggest risk an investor is exposed to is the risk of credit loss in terms of our strategies.
And Andrew, just on that, really, would the risk of a recession really significantly increase that default rate?
It's actually interesting. The recessions are actually quite an interesting environment for us as a lender, because what you end up having is reduced market liquidity. So there's not a lot of capital flowing around. And so what you tend to find is that terms and conditions become more favorable towards a lender, because you're tightening the terms and conditions upon which you'll lend, and the alternative sources of capital are no longer available to the company. And so you tend to find that the pricing goes higher in those sorts of environments. So from our perspective, when markets are awash with liquidity, you'll get looser terms, looser conditions, and lower pricing. When the reverse occurs, then the pendulum swings back in favor of a lender. So in a recessionary environment, you need to be conscious of the fact that, you know, if you're lending to large companies that have good diversified business models, diversified products, quality management, access to alternative sources of capital and supportive shareholders, they're the sorts of things that can weather and withstand deterioration in credit conditions or economic conditions. Again, for us as a lender, what we should be doing is setting the capital structure and the amount of debt we're willing to lend to a company that takes into account the long-term economic conditions. And so we're looking through multiple cycles to determine what is an appropriate level of leverage that the company's cash flows can sustain, even in periods of shock or even in periods where you've got material downside economic conditions.
Thank you. And Chad, just on the risks, I guess.
Sure. One thing to mention is the volatility profile of gold. It does tend to have a volatility profile like a risk asset like equities. So over the course of 18 years, GOLD's volatility has been around 19%. But keep in mind, it's kind of opposite to that of equities in terms of the direction. I think that on the horizon, what I'm most keenly watching is announcement for tapering. I mean, gold is certainly a macro asset, and you can see it perform well when real yields deteriorate. And there was something of an expectation that they would, beginning in 2019, when the Fed reverse course started to decrease rates, et cetera, end of cycle dynamics. But as things consolidate, despite valuation concerns in the macro economy, gold tends to kind of become less pronounced because it's that safe haven asset. Insofar as investors increasingly have this consolidated risk on movement, gold tends to be not favored under those circumstances. So, a taper discussion is something to watch for. When, there was in 2013, the taper tantrum, gold definitely reacted downward to that. But on a long-term basis, like I said, it's there to kind of ride through those cycles. And when you have downside motion to the macroeconomy, to equities, gold tends to stabilize the overall return profile to make that experience for investors better. But, investors do have to keep in mind that gold is not an equity, which is to say that it's not going to give cash back. It's not going to move lockstep with equities, as mentioned earlier, but it certainly has that kind of security asset role for portfolios, so that if something does occur, you don't have to worry about timing it in terms of entry into a defensive like gold. So in a nutshell, that's our view on things.
And just cognizant of time as well, but just understanding specifics around that, and I think opening up to everyone, what effects would I guess this seems to be the point on everyone's radar these days. And I guess given that these strategies are so different to bonds and stocks and the communications that advisors really have with clients, but just on that, what effect would a rise in rates really have on portfolios, on your portfolios and your strategies? And I guess subsequent to that, what type of communication should advisors be having in how they're explaining your type of strategies to clients?
The vast bulk of assets held in our funds, Daniel, are floating rate. So based off a floating rate. So if interest rates were to rise, then the total return to a unit holder or an investor in our funds will increase, and the total cash distributions. So unlike if you're in a fixed rate bond fund where interest rates rise, the capital value of your holdings will deteriorate. In our asset class, you get a stable capital value, and the return in terms of the interest income and fee income that's generated and paid to investors increases and decreases in line with interest rate movements. If interest rates were to rise, chances are that the economy is going strongly. The Reserve Bank and others are trying to dampen that demand and growth. And so you would expect that the companies that we're also lending to are performing well because they're getting the tailwinds of strong economic growth as well.
Yeah, I guess for private equity, if you have a company that's mathematically calculated on discounted cash flow, mathematically the value will fall if rates rise. But sort of as Andrew alluded to, it does more depend on the, the broader economic environment, things like inflation. We do try to focus on companies that have pricing power at the moment because of the risk of inflation, and particularly companies in the earlier stages where there might be, have a different valuation technique than discounted cash flow, which shouldn't really impact it too much. So yeah, we've tried to kind of build a weather-all portfolio. I've just noticed there is a question in the Q&A as well in terms of, it looks like Spider-Man's asked a question, so I better answer it. So it says, does Schroders hedge the portfolio and what's the current MER? Peter Parker asked it. We don't hedge our portfolio. It's unhedged, and we have assets in a variety of different currencies, US dollars, pounds, euros, Nordic currencies. So you've got a basket of currencies, so it's unhedged. And the MER, it was much easier pre G97 because it's 1.8% and 1.48% management fee and about 30 basis points of costs. But it's worth noting that we do allocate a portion of the portfolio to third-party managers to get further diversification in terms of company exposures, and that adds about 70 basis points of estimated indirect costs. So it's coming out at about a sort of 2.5% all-in cost. Obviously, as Andrew also mentioned, for private equity, you're not buying and selling off a Bloomberg screen. You're going out and actively sourcing companies, structuring. So it does usually come with obviously a higher headline cost than listed equities.
And Chad, just on that one.
There is some interest sensitivity that gold does have. So as mentioned, it does trade in relation to after inflation risk-free rates. So if real yields, in other words, in the US market, because gold tracks the US market, it's so deep, it's so liquid, it's so large, that's its reference point. If there is some improvement in real yields, there could be downward motion in gold's price. But one thing I'll mention there is just, every time the Fed tries to raise rates, it hasn't been successful as much as I would like it to be from an American perspective. It's kind of indicative that things are getting better within the economy and normalizing. but actually over the long term, since the GFC, it's been asymmetric to the downside. And so in other words, there is something of a risk that if, the Fed starts to taper, if it starts to raise the short end of the curve as well in 2023 as expected, there could be something of a snap down in terms of real yields plummet again, because it induces a recession and you can't really get out of that. So yes, it's sensitive to interest rates if they rise. But at the same extent, there's a lot of risk that the Fed's not going to be able to successfully do that. I hope they can, but we'll have to see.
No, thank you. I think we're getting close to the end of time here. We've just gone slightly over, but what I really wanted to sort of get to, sort of a last question sort of came in specifically to Claire and Andrew, was just in terms of how you value your investments. How does NAV really compare against something that's marked to market like an ETF or a share?
Yeah, so with our assets, we can look to global comps. So at the end of it, what you're looking for is the comparable credit rating of the company you've lent to, the tenor of the loan, and also the markets that you operate in. So markets do price differently. So for instance, in our market, if you're providing financing to an ASX listed corporate, it will price differently to an SPV financing provided to, say, a project and infrastructure funding vehicle, or to a private equity, operating company that we might be financing. And so what you're looking at is comparable yields to maturity as being the determining price. But the biggest driver of pricing impact on the NAV is the risk of credit loss. And so we as a manager actually have a process whereby all of our fund assets are independently verified on a market value basis and independently tested for impairment risk on a monthly basis. And so that then is reported to the appropriate trustee or RE of the fund to ensure that the NAV is appropriate. And then, I think in terms of our various funds, I would sort of suggest that we probably operate at one of the highest, governance standards in terms of having ASX listed funds with continuous disclosure obligations. The portfolio is regularly churning, and so you're getting regular repayment at par. But the other interesting thing about our asset class is that you don't price a loan at a price greater than par. And that's because a loan can be voluntarily repaid at any time by the borrower for 100 cents in the dollar. And so the best you're ever going to get back in terms of, if you've lent $1, you're going to get $1 back plus interest and fees on the way through. And so the position you're trying to ensure is appropriately captured in the NAV is the risk of any deterioration in credit quality that might impact your ability to get 100 cents in the dollar back.
Thank you. And Claire, just on that one.
Yeah, sure.
Question.
So we have a similar fairly rigorous monthly valuation process. It does take us 22 days to publish the NAV because it has to go through the private equity valuations team, the private equity governance committee, then it goes to a Schroders group independent governance committee, annual audit, or all the things you would expect. And the valuation methodology really depends on the type of company. So venture capital is typically just valued at its last round of financing. As I mentioned, some companies might be discounted cash flow, price to earnings ratio, sales, revenues to earnings. Because we're in the smaller end of the market, we're not usually on that sort of proxy valuing to listed companies, which does help dilute the volatility within the strategy. So yeah, it depends a lot on the company type, but I guess similar to Andrew, a fairly rigorous process that we have to go through every month. So I'm always 1 month behind in terms of performance, which is frustrating to deal with, but yeah, part of the joy of private equity.
No, thank you, Claire, for that one. I think that sort of leads us to the end. I think we've gone a little bit over time. I think we've got through some of those questions. I might invite Toby. Sorry, Toby, for going a little bit over, but conversations that must be had.
Right. Look, thank you very much, Daniel. Andrew, Claire, Chad, thank you very much. I've found this session fascinating, and certainly it's deepened my understanding of private debt, private equity, and that millennial diversifier. Millennial, not in the generational sense, but millennium-wide asset of gold. So look, to wrap up, let me just remind you that on Wednesday we'll be looking again at the defensive asset classes with Alex Stanley from Ardea Brett Luthwaite from Macquarie and Matthew Khalil from Janice Henderson. And then on Friday, we'll be having 3 of the leading research houses, Morningstar, Lonsec and Zenith. We'll be talking to portfolio managers from each house about the way as a researcher they think broadly about alternatives and their incorporation in asset class. Daniel, thank you very much for the job you've done today in moderating today's session, and I'm looking forward to you joining us again on Wednesday and Friday. So to all of you, thanks very much. CPD points for today's session will come out over the next couple of days. There'll be a SurveyMonkey question come out to you very shortly. And we welcome your feedback and your suggestions for topics that you think will be of interest to you with a particular reference to managed accounts. So Andrew, Claire, Chad, Daniel, thanks very much for your time today.
Thank you.
Thank you, Toby. Thanks, everyone.
Bye.